But Antler is
Perfect.
now the world's most active venture capital firm. We will invest in about 500 new companies this year, with 30 offices around the world, operating out of 6 continents. We're about 300 people. And our real kind of key point of difference is that at that first check that we're writing, we're really backing founders. We're not investing in, so much the companies or the ideas. Of course, that is a product of the founders. But our key point of difference here is finding real exceptional talent right at the earliest part of the journey. And that can be first time founders, it could be second, third, fourth time founders who are going on to do their next thing, and partnering with them.
Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and today we're with Anthony Millet, or Ant Millet, who joined this very interesting venture firm, Antler, weeks after it was initially founded. And so he's been building this global VC accelerator group from the ground up. So I'm really interested to get the story, because so many VCs, if you squint your eyes, they kind of look the same. This one is got a very different origin story and the path it's heading on, with a lot of velocity in my opinion, not that many years since it was founded. So Ant, thank you for coming on the podcast today.
Pleasure. Thanks very much for having me.
Yeah. And it's thanks to Todd Rupert, former CEO of T. Rowe Price and former, venture partner or advisor at Greenspring, who's involved with Antler, who brought us together. So thank you to Todd. And also, Ant will be with me. He's dialing in from, I think, the Mandarin Oriental hotel lobby in Boston right now. So bandwidth is working nicely. But will be with us in person on our VC panel in Palo Alto. Is it Tuesday night, October 29th in Palo Alto? If you want to meet us in person, we'll be together talking about all things venture capital and startups. Maybe tell us, I want to hear like the Antler story to get it out of the way, because it's kind of an interesting one. And then we'll talk about, your path and how your origin story from Australia to Singapore to having recently just moved to Utah, which is a very entrepreneurial part of the country in the United States right now. So tell us a bit about, when did Antler get established and where did it start first and how is it spreading into different pockets around the globe and how's it structured?
Yeah, it might be worth just first kind of discussing what Antler is today, and then going back to where we started and how we got to where it is today. But Antler is
Perfect.
now the world's most active venture capital firm. We will invest in about 500 new companies this year, with 30 offices around the world, operating out of 6 continents. We're about 300 people. And our real kind of key point of difference is that at that first check that we're writing, we're really backing founders. We're not investing in so much the companies or the ideas. Of course, that is a product of the founders. But our key point of difference here is finding real exceptional talent right at the earliest part of the journey. And that can be first time founders, it could be second, third, fourth time founders who are going on to do their next thing, and partnering with them right at the start of, at that formation stage, and then going on the journey with them throughout the life of the business. So we're operating this out, like I said, across 30 cities around the world, many of the tech ecosystems on a global basis. And, the background to this is we're the majority of the leadership of the organization. We're ex-operators. We've built our own businesses. We've been on that journey previously. And we've been, astonished at how much of our success was driven by these amazing people that work with us within our organizations. Many who, would leave to go and build their own businesses, and we would sometimes be fortunate enough to go and back them and be a part of their success, but also some exceptional talent that didn't leave to build their own business, who we knew were destined for greater things and had the capacity to do so. And so really what we provide and who we are around the world is really that first great institutional partner that is prepared to get their hands dirty, come in very, very early, help with team formation, help with early validation, build conviction around the founder, which is resulting in us being able to have our unique place in the market and go on that journey with the teams.
And what year did Antler first make its first investment out of a commingled fund, or was it even SPVs back then?
Yeah, so we started with our first fund in 2018. out of Singapore. Our first fund was our Southeast Asian fund. When I joined the business, I came to know of Antler when it was only operational for a few weeks. I just exited my second business that I built, went over to Singapore from Sydney, where I was living, and got to really meet the leadership team, the early leadership team, really understand the point of difference. I think, we're different to an accelerator, we're different to an incubator. Those kind of models are ingesting, existing deal flow, typically kind of 12 to 24 months. This was right at this kind of what we call day zero period, working with exceptional people. And I got to see the exceptional founders that were attracted to come and work with a partner like Antler.
And don't you have like a Helsinki Finnish co-founder, or what's the nationalities or true identity DNA of the guys? I mean, it sounds like you're part of the foundation of the company building, even if it was a few weeks after they founded.
So our founder is a phenomenal entrepreneur called Magnus Grimland from Norway. He found himself doing various things across Europe, a lot of it with McKinsey, and then left McKinsey, went over to Asia to build what became Asia's largest fashion e-commerce platform, which they then exited ultimately as part of a roll-up into and then was listed on the Frankfurt Stock Exchange. So that was built out of Singapore. And it was actually on that journey that Magnus saw what exceptional talent he was incubating. And so a number of his employees left to go and build world-famous businesses like Gojek, Grab, Shopee, Stash, Way.
He was a bit late to be getting into those, though.
They were his employees. They were his employees that left the company that he was building. So, what he recognized was that, his company, Zalora, was the training ground for these many excellent people. And so where Antler really started was from a unique insight that we knew where this next generation of talent was. We knew how to identify it and partner with these people. And that's really where the idea of saying, well, look, there's all these investable opportunities and we can go and compete with every other VC fund. Or how about we go and do something quite different, which is get to the exceptional entrepreneurs early and be there early and be there almost at the point of company formation or prior to company formation, and really help support them with those early years.
Okay. And with, there's a bit of what's the history, but with today, is Antler set up as a bucket for Southeast Asia of like Indonesia, Malaysia, Singapore, Vietnam? I think those were the countries it was fencing in. Is it only allowed to invest there? And is an LP investing in that dragged into an investment you're making in Utah? Or so is it many separate buckets with many of the same LPs? Or?
Yeah. So I think the first thing to say is that we're a global firm. We operate as one global firm. We're not a franchise model. We all work in partnership, and there's huge benefits that we're finding from running the Antler methodology and the Antler process on a global basis. But ultimately, the decision making around investing is done locally. So in each of the regions, we've got 14 regional funds that we call it.
Right. That's what I thought.
And so LPs that we partner with, and they range from, high net worth individuals, family offices, all the way through to insurance companies, asset managers, and sovereign wealth funds, will either invest in a particular region, but as a result of kind of a desire to get access to the asset class on a more global basis, we've also created global vehicles as well. So investors get the opportunity to pick and choose geographically or globally how they want to partner with us. And then to kind of continue the story, we started in Singapore in 2018. 2019, we launched Sydney, Stockholm, London, Nairobi, New York. And then in 2021, expanded into India, Central Europe out of Berlin, Copenhagen, Oslo, Austin, Sao Paulo, etc. And I kind of forget some of the years that our locations were launched, but we've ultimately got very, 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 very good geographic coverage now, really, of the world.
Yeah. I mean, the reality is if you agree to create a legal structure that will only invest in UK domiciled companies, you could probably get the BBB, British Business Bank, to give you, 40 to 60% matching funding. And if you agree to fund Malaysian companies, someone like MavCap, the SOV they'll give you some sort of matching money. So it would seem to me like it makes more sense to create a separate bucket for these things so you can give these SOV vehicles what they want and then allow your financial LPs to be in all the buckets or even select the ones they want to be in?
I think,
What's your experience being in there on LP fundraising?
yeah, I think definitely from the LP side, a lot of these sovereigns absolutely do have very, very, very bespoke mandates, which I would say they're probably more flexible around regions rather than just individual countries in some aspects. So Asia, we do partner with Khazanah, the Malaysian Sovereign Wealth Fund. In Europe, we do partner with, a number of the broader kind of sovereign wealth funds that are happy to participate as long as we're obviously participating in their country. But I would kind of take a step back and go, our funds initially were not designed around trying to capture capital from specific LPs. Our funds have really been designed around how do we generate the best returns, and that comes from a function of how do we want to attract the very best people to come and work at Antler and be our general partners, and how do we attract how do we attract those. And then as a result of that, how do we also attract the best founders to come and work with us? And so if you're looking at some of our regional funds, let's take the UK, for example. We've got a fantastic founding team there, or GP team in Adam French and Jed Rose, deeply experienced there. Ultimately, they want to come and work for a fund where they are outsized. They're rewarded on an outsized basis for their contribution for what they can do. And there's no one better place for making investment decisions, attracting founders, working with those founders on a hands-on basis in the UK than those two people who are working day in, day out with the founders over a multi-month period in our offices. And so we want to create an environment where we're able to attract the very, very best GPs who are disproportionately rewarded for their contribution to the returns that they're generating, rather than everyone kind of being part of a commingled fund where you kind of potentially lose accountability. So that's worked really well for us because we're able to attract great GPs and say, hey, look, you should come and launch with Antler in a particular location. You're going to get a disproportionately larger amount of the carry, but these are also the expectations of you in terms of performance and your ability to attract great founders, etc. We obviously work very closely with all of our GPs in making sure that the performance is top notch and we're constantly learning and improving. But we've designed the model, like I said, from a performance driven basis, and then ultimately being able to find the right LPs to back us in various locations.
I find this intellectually interesting topic to me of you got a couple of stakeholders you need to make happy. There is one, you're not much of a VC without the capital. So how do you make this attractive to LPs to get them to invest in your UK fund or your Southeast Asia fund, your Mexico City, Brazilian, et cetera funds? Then there's how do you make it financially motivating and attractive to the best GPs and other team members to work at Antler London or any of these 30 cities? And then there is the third one, which in many ways is the most important one. How do you make yourself so attractive to the entrepreneurs that, given a choice, they're choosing to partner with Antler for not just cash funding, all of the connect the dots that, hey, if I raise money in this city, they're connected to 29 other cities, and they've managed to turn this up since 2018, a relatively short period of time, in my opinion, that where will this be in 20 years? And this might not be my last startup that I'm getting funded with Antler here in Mexico City or Southeast Asia, Singapore, or whatever. So it's interesting to get those three things right. How do you motivate a member, whether it's a GP or a junior person in any of these 30 cities, to support a startup that's funded by a different vehicle? Or do you have anything specific in place? Do you keep points of, hey man, she picked him up at the airport, drove him around, set up all the meetings in New York, even though that was a Singaporean company who's thinking of relocating to New York or just wants customers because they're in New York? How do you do that?
So,
or is that evolving?
No, I mean, it is always evolving, right? Because we can always get better. I would say that one of the things that we've done right from the very start, a foundational piece, is so Magnus Grimlund came out of McKinsey, and when our first ever chairman was a gentleman called Dominic Barton, who was the chair of McKinsey, then unfortunately had to leave us because he became the Canadian ambassador to China and had to give up all of his various other roles.
Well, that guy could write a book just on that.
Just
Canada
for
and
sure.
China. Even Australia would be pretty interesting to see either of those ambassadors tell you what really happened with we're banning your wine and we're locking up your daughter or whatever happened.
I think that's a different podcast episode, right? But we probably
It is, yeah. I'd like to have in the pod.
That's probably
great.
the extended podcast. But one of the things that Magnus came in with, right, was he knew that he's from the start is like, we didn't accidentally grow into 30 cities. Like, that was always the intention, and that's obviously very clear by the fact that, you know, within 1 year we were in 6 cities, within 2 years we were in 12, etc. And one of the things that, if you think about like big global firms, and I think McKinsey is a good example of this, is like, it's pretty amazing how they are expert at everything, and it doesn't really matter where you are in the world. If you need advice on a particular topic, there is someone that can answer that. And it, you know, you might be in Sao Paulo, but the expert on, you know, understanding cross-border payments might be operating out of Berlin or might be operating out of Singapore. But the ability to bring that expertise to you, irrespective of where you are geographically, whether it be because it's relevant for your local market or you're thinking about expanding internationally, is there. And so you think about, well, you know, you look at some of the compensation schemes of these and go, well, how do these giant global networks work so well together, and what are the things that sit behind it? And one of the things that Magnus really got right from the very start was the way that the partners are incentivized, and the whole organization is built. And it's actually never really changed much since day one, which says a lot for how they got it right. But in our local funds, the large majority of the carry remains with the local partners, who are the ones that are ultimately responsible for building, managing their own teams. They are also responsible for finding the founders, and they're making the excellent, you know, first investment decisions and writing those first checks. Some of the, I said the majority of the carry stays domestically. Some of the carry that goes offshore goes into a global partner sharing pool, which means that everyone globally is exposed to every single company. So you can imagine, we're in the law of power. We're in the business of power law returns, right? We're entering our businesses on $1 to $2 million valuations. And our biggest businesses now, you know, that are starting to get to 4 to 5 years old, we're starting to see a number of businesses turning over many hundreds of millions in revenue, getting valuations, you know, approaching or exceeding $1 billion, etc., where we're sitting on, you know, 5, 6, 7, 800x multiples at this moment in time, and continuing to ride these positions. These companies are very, very important for us as an organization globally, and we want to make sure that we're incentivizing everyone to collaboratively work together to continue to promote our winners to become even stronger. And so I'm sitting here now in Utah, but if I kind of go back 2-3 years ago, or maybe even, you know, 6 years ago, when I was part of founding Antler in Australia, you know, the number of times I would, you know, call my colleagues in the US and said, hey, we've got a company here that's progressing really well. They're coming over to the US. They're going to be doing a fundraising roadshow. You know, they're meeting these 6 investors, but they also want to meet these 4 investors that we know you guys know better than I do sitting here in Australia. Please, could you make the introduction? They're very willing to do that, because they know that ultimately, if that company ends up being a success, everyone wins. And so we've got this.
The short answer is that you've carved out a little bit of this 20% carry performance fee and allocated that to a global pool. You're spinning up new funds, sounds like, on a quarterly basis. And so the carry pool that's global is growing and continually diversified. And so every member of the 300 people globally are financially motivated to make every Antler-backed company successful and connect the dots.
Exactly. I would say probably just the one correction to the comment there is, we launch a fund every 4 years in every location. So we get that we are investing extremely early. We actually only end up investing in 0.4% of the founders that apply to build with Antler. So we have a pretty rigorous selection process to get into our residencies, and then we spend 2-3 months with the founders to then invest in what we believe are the very, very best opportunities, which is really about underwriting the founders. But we also know, you know, whilst we're at the riskiest end of investing, or we're the first check in, we think there's a huge amount that you can do to de-risk early stage investing or inception investing through building largely diversified portfolios, which are diversified not just by number, but also by time and over vintage, because ultimately we don't know what the exit markets are going to look like by the time we come to take money off the table in some of these positions. And so deploying over a 4-year period, which is pretty typical for one of our early stage funds, means that you're able to build a portfolio of 100 to 150. I would say very, very high conviction bets. I want to be clear that these are the top 0.4% of founders that we found, but also with time diversification that ultimately means you should create far more consistent outcomes in terms of the ability to find outliers.
Okay, so a couple things there to make sure we get it. So with your pre-seed funds, you are diversifying to 100 to 150 different companies in one vehicle. You're also, in your minds, thinking diversification over vintage of 4-year period gets you into a bit of a cycle with some diversification of 2021 valuations were different than 2023, 2024 valuations, as well as where's the exit market during that time frame. If you invest in, for simple math, 100 companies in one of these funds, do you have any reserves, or is it one-time shot, no reserve? And that's a separate vehicle for reserves. Where are you on portfolio construction of that?
So we generally in our funds, about 50% is primary checks on the fixed terms that we have in each of our locations. And then about 50% is for follow-on. And we're really trying to protect or marginally increase our position going into the Series A. And then I think if you look, we spend a lot of time talking with our peers and some of the best VCs in the world. And I think, again, if you talk to a lot of them about what are their biggest mistakes, many people often expect to hear, oh, we missed this company or we missed that company, etc. But actually, often what you'll hear is, Y Combinator, for example, say if we had 1 percentage point more on Airbnb, it would have had a transformative effect. It already had a transformative effect, right? But just that 1% more on a company that exits at 20 or 30 billion.
Being able to make a follow-on investment into your winners when you had high conviction, this is still a sensible valuation, exercising your pro rata or a super pro rata to maintain or increase your ownership percentage is probably the biggest miss that any VC has had that you've spoken to. That's what
it often is. It often is. I was saying that you might expect
at the same time, you mentioned fixed terms, and I want to get into what fixed terms mean. Fixed terms sound, very opportunistic compared to just now that this is an Airbnb and everyone's chasing this hottie in a tale of two cities that one startup can't raise money and everyone's trying to get into that. Uncapped notes or high valuations can play into that as well. So within this one vehicle, you're saying 50% reserves, and if you invested in 100 companies, keeping to that simple math, and I recognize sometimes it's 150, what percentage of your portfolio companies receive a follow-on investment?
It's getting pretty high now. It's getting in the high 60s between locations, in the high 60s through to kind of high 70s. And we're generally finding now that for companies that come to Antler and build with Antler, I'll take the US as an example. So I'll take the US, our latest US fund, and I'm just spending a lot of time with our New York partner at the moment. This year, our US office has funded 64 new companies, which typically we'll do about 30 every 6 months. So 30 of them, I'll say, are a hangover from last year that got funded in January. But of those 64 companies, 85% of them have already raised follow-on funding within, yeah, which is really exceptional, right? Which is a sign of the times, the fact that there's definitely a very, very visible and strong recovery underway, especially at the earlier stages.
But that's a high graduation rate. That's a high graduation rate for the stage at which you're investing.
It is a high graduation rate, and it's definitely at the upper end of what we've seen historically. But I would say the other thing that we've done is we've followed on in almost all of those instances, because our conviction remains incredibly high in these founders that we've backed 3, 4, 5 months prior. And so the ability for us to continue to partner with them and participate in their follow-on funding round is there for us, and it's advantageous to us. And obviously the founders appreciate the sign of conviction from us continuing to participate in those rounds as well.
Okay, Ant, can you speak a little bit about the fixed terms you have with regional funds? Like, it almost sounds like Y Combinator playbook of, and maybe how does that pair with stage? And I know that you also have like a co-founder matching service.
Yeah,
It seems like something that you guys operate in.
exactly. So, very, I guess, somewhat similar to Y Combinator. I'll just kind of draw the big difference is that the average age of a company that goes to Y Combinator is about 16 months old, whereas the average age of the company that comes to Antler is generally, 0 months old or right at the very start. Right, we're often working with founders who haven't yet incorporated their companies. So I'll just draw that difference. But yes, we have in the US, we're investing 100K for an 8% stake. And in addition to that, we have something called the Antler Rolling Capital Agreement, or ARC, which says we will also give you a further 300K, matched 50 cents for every additional dollar that you raise within the first 12 months of us investing in you. So we'll already agree to
what
invest.
What if they raise on like a uncapped note, or what if, I mean, you've got a lot
Yep.
of companies in there. What if they're raising at 100 million pre on, 10K MRR? Are you obligated to match crazy?
We're not obligated. We're not obligated, and I will say that we are seeing a lot less of that in this market. We're not obligated. I think in the majority of circumstances, I mean, if it doesn't happen very often, but I would say on those rare occasions where you have something that is so hot, every single best VC in the world is piling into this company, and ultimately, I would say this founder. It's important also for us to be participating. The biggest misses that we are likely to make are not backing the exceptional founders who we know are exceptional founders, rather than thinking we can predict the future than other people, or as well. So look, we're not seeing these crazy $100 million pre's very, very frequently. I think a lot of that, I mean, there is stuff like that going on, and it tends to be at the kind of more deep tech / AI, bets on building the giant bits of infrastructure of the future. But generally speaking, the traditional route that we're seeing, and actually it's worth digging into this because this is evolving, is a company will come to Antler, we'll get to know, or founders will come to Antler. We may help them with co-founder matching or finding, for a really strong commercial or domain expert, helping them find their technical talent and vice versa. We build conviction with them as they build conviction in what they're doing over a 2 to 3 month period in person. They're also part of this great community, and I think one of the deep insights that is worth sharing, it's quite obvious, but maybe not talk about it, is like founders want to be around other exceptional founders when they're building as part of a community. Like, it's a really hard slog and a really hard journey, and so that becomes a very attractive proposition as to why exceptional people are, and second and third and fourth time founders are coming to Antler. Ones who've already had IPOs have lessons from their first journey and want to come and make sure that for their second journey that they can they're building a better community around them, or better co-founders, etc., or different co-founders. And then the traditional journey is they'll come, we'll work with those ones that we become highest convicted in, and then they'll go from their 2 million round to raising probably more of a traditional pre-seed seed, where they'll raise anywhere from kind of, I would say, 1 or 1.5 through to kind of 5 million on a kind of 8 to 15 mil val, and then you go on from there. What is actually quite interesting that we're seeing a lot in this market of now.
And can I just ask, so kind of the deal that most of these companies are offered is that you're going to offer a 200K check for 8% equity of the company, and are you managing to do that as a priced round in the United States to trigger QSPS, or is that on a safe?
It's on a safe, but it does trigger QSPS.
Okay, right.
Yeah.
I mean, I'm seeing a lot of people just write it in, QSPS into the safe. And then you offer this, for ongoing, was it ARC or whatever that program is, you're willing to do dollar for dollar 50% matching until you've deployed an additional 3K.
Exactly.
Right?
Exactly.
Okay.
And
can you, but you also kind of said that you might participate in the Series A. I would
think
that there's going to be some funding between the pre-seed birth funding round that you're doing and a Series A. Can you hold off? But you can't hold off. Like that 300K is going to get gobbled up on the next fundraising.
Correct. Right? But we then have the reserves to also then continue to participate in seed or pre-A rounds, right? So the general simplification of this is that our early stage funds around the world are writing those initial pre-seed checks and following on all the way through to Series A. And then we have a global, in 2021, we raised a global follow-on fund or continuity fund that is backing the winners that emerge from around the world from Series A through to Series C. And we're just coming into our second vintage of doing that. Will be next year, etc. As we have a fuller pipeline. You can imagine 1,300 companies that have been built and created over the last 5.5, 6 years. The velocity at which companies are now globally coming to Series A is really starting to ramp up. And so next year we're excited to launch our next series of growth funds that will continue that journey from A to C.
And can you describe, like, Techstars in the original, David Cohen, Brad Felt supporting days was a 3-month accelerator where month 1, let's meet all the mentors and go over your strategy and come up with what we're really going to do. Month 2, build and try and get some initial commercial traction or revenue of some kind. And month 3, we're going to teach you how to raise VC funding, and it ends in a demo day. And then it's everybody get out, new freshman meet come in, and you're kind of done. IC has their thing. Would you describe your program as being like a cookie cutter organized program, or is it very much you can come in here and be around all these founders as long as you want? Like, how do you guys run it as far as a structured curriculum or mini university program?
Yeah, I think different founders need different things and need different support, and that could be down to specific skills of how to capital raise, etc. It could be helping them find co-founders. It could be introducing them to people in our network. And so I think we've learned over time that some structure is particularly helpful, especially if we want to have the number of investing opportunities that we want to have every year. Then we need to build structure around that process. This year, 160,000 people will apply to build a business of Antler, and, we'll end up backing 800 of, just under 800 of them. So you have to have structured processes for those to be able to enable that. But then I think, like I said, every founder is quite different, and the support that we provide them can be general, but becomes quite bespoke. So we'll bring into our residency generally twice a year in each of our cities, somewhere between kind of 80 to 150 people who will spend 2 to 3 months with us, or I would say 2 to 3 months with each other, right? And I want to kind of stress that point, because it really is like I'm starting this journey and I'm surrounded by 100 other exceptional people that have got phenomenal track records of doing amazing things. And that is both exhilarating, motivating, and cause anxiety, quite frankly, sometimes, but an amazing and very unique environment to start building your business from within, rather than, sitting in a WeWork on your own. We generally, after that 2 to 3 month period, we'll make those investment decisions. And then we're often encouraging or really want, or the founders and the companies really want to kind of hang around with us for longer, and generally will stay with us.
Oh, so the 2K and offer commitment for another 300K happens not at time 0, but it happens maybe 2 months in.
Yeah.
After the residency, as you're describing it.
Exactly. And I think actually that's probably
okay. So you're like the YC pre-demo day guy. You're like in the halls of YC, getting to know everybody, and then saying, "All right, I'm not going to wait for demo day, but I'm also not going to invest in everybody on day 1."
Yeah, and I think that's I think that's a really important distinction to make, right? Because all of this early stage investing is 99.9% on the founder and the founding team. Like you would never want to be backing a mediocre team with a fantastic idea, but you would very happily back a phenomenal team with what might look like a mediocre idea, knowing that so many of those ideas pivot and ultimately their mediocre idea may be the one that wins. And who are we to say what the future is?
That is what life has taught me. And anytime I deviated from this, the universe punished me viciously for not focusing on that. I often say that in real estate, the 4 most important things are location, 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 location. In the world of investing in early stage startups, it's management, market, technology, in that order. And the final thing on that is that in a world of pivots, a lot of these companies pivot.
Yep.
After a pivot, what are you left with is the damn management team, right? That you backed to begin with. It's like, bet the jockey, not the horse. Okay.
Yeah.
And what percentage of companies that go through a residency program do not walk away with Antler cash funding? Roughly.
Yeah, I mean, I think it's generally about a third. We generally back about a third of the people that come in. So if you think about 100 people coming in, we'll probably end up investing in anywhere between 10 and 20 teams. If you assume that that's kind of two, sometimes three co-founders per team, that's kind of 20 to 30, 20 to 40 people. So, take the middle point, it generally ends up being about a third of people that come into our residencies will end up backing. So that is a really key distinction to make, right? Because a lot of these other environments, the offer of investment is made off a few interviews and a few meetings. And then, it's really once you start working day in, day out with these founders and these companies that you will form your own opinion of like, what is their ability to execute? Like, how committed are they to this thing? Are these the people that are just absolutely obsessed about this and making this their life work and, working all hours and, breaking through brick walls every day? Or are they just very, very smart people that are happy to make this a kind of a 9 to 4 thing? And, if it becomes big, fine. But if it's not that big, maybe that's fine for them as well. The ability to, I would say, write less bad checks is great. It means that after 2 to 3 months of working with people, who's got that drive, who's got that hustle, who's probably, if someone's building in an area, is it likely that these people are going to be top 5 in the world at doing it? And, you build real conviction around that. And so by the time we actually write the checks, the conviction that we have in these founders is obscene because you've worked with someone for 2 to 3 months. You have really unique insight.
I'll bet you some of these founders go into the residency with their startup and then they realize that they're in a cohort with the next Airbnb and maybe they should join that one. So, that's an exact dynamic and people are so important to execute rapidly on things like this. So with these numbers you're talking about, how do you attract so many applications at that stage and how do you process it? I mean, I personally receive, if I were to tell the actual number of emails I get from pre-revenue companies, it would probably scare a civilian LP of you must be paralyzed, and a simple way is say, hey, come back when you got this much revenue. Get a lot of stuff off my desk. But when you're opening yourself up to the stage at which you're investing in, how do you attract that much into the top of a funnel? And even with 300 people, how are you processing that volume of deal flow in a sensible way?
Yeah. So I think the first thing to say is it's, I said this before, the biggest mistake that we can make is not backing an exceptional entrepreneur right at the very, very start. So for us, this is something that we can't ever get, slack on. It's not something that we ever take our foot off the pedal on. And it is hand-to-hand combat. And we are there at the earliest stage, finding exceptional entrepreneurs. We've built proprietary tools for identifying people that we think have got really, really interesting backgrounds and approaching them in I would say slightly more automated ways and using, reach outs on various channels, etc. So, and then I will say over the years, what has become a majority outreach program is now really well balanced between outreach, but also, and we get a lot of referrals of exceptional talent. One from our portfolio founders. You tend to find that, exceptional founders tend to hang out with other exceptional people. And if they've had a great experience, which I would hope that most of our portfolio founders have, they're constantly, their friends have seen the journey that that they've gone on. And naturally we get a lot of referrals that way. We also get a lot of referrals from VC who, just see exceptional founders, but go, look, you're just too early. Like we can't write a check into you, etc. But go and work with Antler. They can help you with these various bits of, what is not polished around what you're doing, or maybe you're missing a co-founder or something else. And so we get a lot of referrals from, the VCs, tier 1, tier 2 VCs all around, the larger and smaller VCs globally, who send us great talent and obviously want to see how they're performing to hopefully catch them on the other end and work with us in building and shaping something really exceptional there. So that's really where, and our general brand as well. So that's really where we kind of fill the top of the funnel. And then in terms of processing it, every location of the 300 people that we are, probably 60 to 70 people are full-time on screening the CVs, screening the applications, then having initial calls with probably close to about 40% of the candidates, then working out if that gets pushed through to then a director level call or a partner call, etc. But by the time someone comes into our residency, they have all spent time with our partners, and it's our partners who ultimately decide, are we going to spend X amount of time working with this person in the residency?
And we're going to run out of time. And I got a couple of questions I'm just
Sure.
genuinely really curious about. It'll be great to have you in person next week at our event on Tuesday night. With all these different regions, what do you observe as key differences on ability to attract more follow-on funding? I mean, if you're in Silicon Valley, there's a lot of funders for every single stage, for every single sector. If you're in London, it may feel like a lot, but if you get rejected by 200 VCs, there's nobody left. Whereas 200 is just the beginning of a process in say, Silicon Valley or New York these days. So one is, what are the differences of the key regions on attracting follow-on financing as these ecosystems are still nascent and developing? And what are the differences in exits? Like, for example, people have told me that an exit in India can be very hard to crystallize. Even going back to Magnus out of Norway, he exited a Singaporean business that he built on the Frankfurt Stock Exchange, if I heard that correctly. So what do you see on those two? Follow-on funding per region, challenging, or maybe that's an opportunity for you to get in at lower valuations. And then what do exits look like in these different regions? And which one's the hardest?
So on follow-on funding, different markets are different, right? So you're absolutely right. In US, you could probably go and have there's something like 9,000 VCs. I think that's down from a high.
Then again, more competition. You might be the hottest, GoJet deal in Indonesia, and everyone wants you because you don't have a lot of competition, maybe.
Yeah. So I think in the US, from a founder's point of view, and looking through a founder's lens, right? Like if you're a high quality company, a high quality founder, there are a lot of doors that you can go and knock on, and ultimately, there's famous stories of Airbnb being rejected by 100 times, and we know out of the Nordics, Spotify being rejected by 100 times, etc. There's a lot of doors you can keep knocking on to ultimately get the job done, and we obviously do a huge amount to help them. I'll take Australia as an example. There's probably only 20 credible VCs. So if you're knocking on 20 doors and they all say no, where do you go next? Yeah. And I would say that these markets,
that can happen very fast.
Yeah, these gaps at the earlier stage have generally tended to be filled by family offices and angel investors. And it's also true in the US that a lot of our companies will work at the earlier stage with family offices and angel investors, not because they can't get VC funding, but generally, they can often be more strategic or bring something else to the table rather than just the capital. So we work very, very hard in every single location to form really strong relationships with those follow-on funders who will come and partner with us as we go through the lifetime of a company. Because ultimately, if our companies don't get that next round of funding, then they're not going to generate very strong returns for our portfolio. So we're
running out of cash, number one cause of death.
So ultimately it is, the US is absolutely the most developed. India has a really large number of VCs now, actually. And that for us, we partner a lot with those guys. Southeast Asia has a pretty decent amount. Europe is absolutely on the rise at the moment. There's more funds starting up there. And I think the rhetoric of Europe being left behind is really starting to turn. You've also seen a lot of government investors in Europe becoming far more active, even on direct deals. And in those other markets, which, I generally feel that the world is developing on this. There are more and more funds coming up, and and the sophistication around VC investing is definitely continues to be on the up. But we really supplement it and make sure that we've got very, very strong follow-on funding sources in all of the locations that we're in. So that was the first thing. And remind me what the second part to the question was. Yeah, so there's
what's it like getting out of a company in India compared to Boston or New York?
Yeah, so there's really two types of exits. One is because we go in so early, we may take money off the table in secondary or start to shave our position in secondary positions as your secondary sales as these companies start to hit kind of Series B, Series
C. Very smart. Regardless of location, that's a smart strategy.
Regardless of location, I'm generally finding that the latest stage for VC support and funding is actually probably less of an issue in most of the markets that we're in rather than the earlier stages. So, we're probably yet to form a full view on that. But what I would say is that a trend that we see globally is that there's exceptional talent pretty equally distributed around the world. And many of those people are not just building domestic businesses, they're building global businesses. And they have the tools from a technology point of view and have access to talent and now capital to be able to build these exceptional businesses irrespective of where they're starting. And so what we're seeing as a trend is a large number of companies starting from various places in the world, but once they kind of start to hit their Series A, Series B, moving to the US because it's actually a strategic market for them, and then falling into the US funding, infrastructure. And so ultimately, there is an arbitrage opportunity on a large number of our funds to be able to back in these markets that are somewhat less competitive, where we're able to get in at really advantageous pricing, but you do get that really decent markup as well when these companies, as they become more global.
Okay. And final question we'll close on until we continue this in person next Tuesday night in Palo Alto is LP sentiment. You guys are raising for many different funds continuously, it sounds. What are you experiencing with LPs, seeing the light and wanting to plow more cash into Antler funds? Or, what's that roller coaster been like, or how consistent has it been?
I think the first thing to say is I think the market is still really challenged from a VC fundraising perspective. I think it's less about concern of where valuations are and is there good value to be had, and is this a good sector to be putting money into. I think history will show you, first of all, valuations have really come back down to very, very normal, I would say normalized levels. And then also, history shows us that post kind of very depressed periods within the sector, or post the peaks, have been the best times to actually put money into the sector, because you've got more capital conscious founders that are building more sensible businesses, and you're not in this kind of period of ZERP that we saw. For those LPs that have cash, we're working with a large number of them because they're attracted to our differentiated model and kind of thinking about, well, is venture over the last 20 years going to work out exactly the same over the next 20 years? And who's got unique and proprietary advantage on both pricing and access to new technologies, founders, and deals? The biggest challenge that we still see in the sector, and this is shared by many of our peers, is that a lot of the LPs have just not had any returns for 3-4 years. And until they start getting returns, it's really hard for them to increase their allocation into venture. So that's probably the biggest challenge for the sector. We are finding different buckets with some of these LPs to be able to be put into, so that they can start working with us now and invest in what we all believe to be an extremely attractive time. But it's not easy, and all the stats will kind of show will kind of show that. But we're also incredibly grateful for those LPs who have come on board with us over the last 5 years, especially over the last 2 years, where we know it's been a harder thing to achieve given the challenges that they've had with no returns.
Sure. Yeah. I mean, if the LP requires liquidity before they'll put more cash in your next fund, the answer to that is we got to find us a new LP, and just work a little harder to find the next one that is ready to be part of what's going on in AI and all this disruption that's happening at the actual startups and big players. Well, good, Ant. So I'll put a link to the show note if anybody wants to join us next Tuesday in Palo Alto. We're getting together at 5. Our VC panel starts at 5:30, 5:40. And we have one of our companies giving a short presentation by like 7:30. It'll be networking till 9. So everybody gets to meet everybody at a cool, intimate event next week. And thanks so much for making the time today. I'll see you next week, Ant.
Pleasure. Look forward to seeing everyone next week.